Today, plan for more falls ahead. Hi again, it's Martin North from Digital Finance Analytics. Well, notice post covering finance and problem news with a distinctively Australian flavour. When the JPMorgan Chase & Co. Chief Executive Jamie Dimon says the United States and the global economy could tip into a recession by the middle of next year, it's time to adopt the brace position. These are very, very serious things, which I think are likely to push the US and the world, I mean Europe, is already in recession, and they're likely to put the US in some kind of recession 6 to 9 months from now, he said. And he said the S&P 500 could fall by another easy 20% from the current levels, with the next 20% slide likely to be much more painful than the first. Runaway inflation, big interest rate hikes, the Russian invasion of Ukraine, and the unknown effects of the Federal Reserve's quantitative tightening policy are among the indicators of a potential recession, he said in an interview for CNBC. Earlier this year, Dimon had asked investors to brace for an economic hurricane, with JPMorgan, the biggest US investment bank, suspending share buybacks in July after missing quarterly Wall Street expectations. And in June, Goldman Sachs predicted a 30% chance of the US economy tipping into recession over the next year, while the economists at Morgan Stanley placed the odds of recession in the next 12 months at around 35%. We continue to expect that the Fed will hike by 75 basis points in November, 50 basis points in December, and 25 basis points in February to reach a terminal forecast of 4.5 to 4.75%, Goldman Sachs said in a more recent note. And Fed Chair Lael Brainard said on Monday that a second-half rebound will be limited and that real GDP growth will be essentially flat this year. The slowing growth, however, doesn't appear to be dissuading the Fed from its path of monetary policy. Monetary policy will be restrictive for some time to ensure that inflation moves back to the central bank's 2% target, she added. Despite growing concerns by a number of economists and analysts that the Fed's interest rate hikes could increase unemployment, Chicago Fed President Charles Evans continued to back the central bank's attempt to lower inflation, saying that while it sounds optimistic, he believed it could also do so while also avoiding recession. People are worried about the economy. People are worried about a possible recession, said Jake Dollarhide, Chief Executive Officer at Longbow Asset Management. There's more of the doom and gloom from these folks and what they're going to do to the economy because they're not so convinced that they have inflation under control, and that's the macro play that's weighing on oil as well, said John Cudliffe, partner at Again Capital in New York. World Bank President David Malpass and International Monetary Fund Managing Director Kristalina Georgieva also warned on Monday of a growing risk of global recession and said inflation remained a problem after Russia's invasion of Ukraine. Dimon's comments come as the big four US banks are set to report their third quarter earnings from this Friday onwards. And so far this year, the benchmark S&P 500 index has lost about 24%, with all the three major US indices trading in bear market territory. Now, we're also clearly entering difficult liquidity territory, as, for example, the Bank of England tries to head off a cliff edge this Friday when its £65 billion emergency bond buying programme ends. That's a fortnight-long bid to save the British bond market by boosting the firepower of its intervention and adding new weapons to avoid a meltdown at pension funds. Bond prices had fallen further, potentially putting the £1 trillion of pension funds' money at risk until the Bank of England stepped in to calm the market on September the 28th. And then the Bank of England said it would spend up to £65 billion until October the 14th to purchase long-dated gilts, that's the treasuries in the UK, providing a counterparty buyer to the sell-off by pension funds' liability-driven investment managers. And in fact, the bond market rapidly stabilised to the extent that the bank did not even have to spend anything like the £5 billion a day it was prepared to inject. But The question, of course, is what happens next. In the 8 auctions so far, it's actually bought only £4.6 billion worth of bonds in total from a possible spend of around £40 billion. And to continue to support the markets, the Bank of England said on Monday that it would this week double the maximum potential size of its daily bond purchases to £10 billion using the funds that it had not spent over the last week. And the Bank of England also announced a temporary, expanded collateral repo facility which will allow LDIs to use a wider range of collateral to meet banks' margin calls, including corporate bonds. And it will extend its long-term repo operations on Tuesdays so that these will give banks more liquidity to lend to LDIs using gilts as collateral. The Bank of England said that the under-pressure LDIs had made substantial progress in the past week in tackling risks of their resilience from volatility in the long-dated gilt market. The bank will continue to work with the UK authorities and regulators to ensure that the LDI industry operates on a more resilient basis in future, the Bank of England said in its statement. Now, the context here is Chancellor Kwasi Kwarteng's budget, which will be the next piece of major fiscal statementing, and he's actually brought it forward. He hopes to prove to the market that he has a credible plan to pay down the debts that are funding his £45 billion tax cuts and the £60 billion plus energy subsidies. It's now going to take place on October the 31st. That's in advance of the next Bank of England meeting on monetary policy that's scheduled for the 3rd of November. The bank is also planning to start its balance sheet reduction program on that day at the moment, but that may change, of course. And in another gesture to nervous markets, Kwarteng signalled a seeming end to his mission to break what he and Prime Minister Liz Truss had called the Treasury orthodoxy on economic policy. Having sacked the Treasury's top mandarin on his first day in the job, the Chancellor on Monday abandoned his plans to recruit an outsider to the role. Instead, he announced that the job would go to one of the department's former deputy heads. All of this, though, did not appear to have much of a soothing effect. The 10-year government bond yield has climbed back towards the 4.5% it reached after Mr. Kwarteng announced his debt-fueled fiscal spree on September the 23rd. And the Office of Budget Responsibility will also run the ruler over his October 31 statement, where he's expected to set out supply-side reforms and spending cuts that will prevent Britain's debt-to-GDP ratio from spiralling much beyond the current level of 100%. The government's popularity has dropped like a stone since the mini-budget, with the Labour Party opening up a lead over Ms Truss's Conservatives of more than 30 points in some polls. And the markets are worried that Truss and Kwarteng have lost the political standing to deliver any spending cuts. And this is prompting traders to increase the costs at which the government must borrow. And the markets also worry that the government's tax-cutting measures will stimulate inflation, even as the Bank of England tries to contain it with interest rate increases, creating a kind of policy tug-of-war within the British economy. In fact, both Mr. Kwarteng and the Bank of England Governor Andrew Bailey are in Washington for the annual meeting of the World Bank and the International Monetary Fund, where they're going to try to reassure markets, lenders, and their international peers. The IMF publicly criticised the British government's handling of the mini-budget, prompting a backlash against the Washington-based institution from Conservative ministers and commentators who back Ms Truss. But of course, these higher bond yields translate simply to higher costs of government debt and also higher interest rates for mortgages. And at the moment in the UK, mortgage rates are going through the roof, which is putting a whole lot more pressure on the banking system and on individual households at a time when inflation is, well, horribly high. All of this sounds a bit familiar, doesn't it? Anyhow, US stocks fell on Monday, with the Nasdaq posting its lowest close since July 2020, as investors worried about the impact of higher interest rates and pulled out of chip makers after the United States announced restrictions aimed at hobbling China's semiconductor industry. By the way, the US bond market was shut for the Columbus Day holiday on Monday. The Philadelphia SE Semiconductor Index dropped 3.5% after the Biden administration published a set of export controls on Friday, including a measure to cut China off from certain semiconductor chips made anywhere in the world with US equipment. So shares in Nvidia fell 3.4%, while Qualcomm, Micron Technology, and Advanced Micro Devices also ended lower. The Dow Jones Industrial Average fell 0.32% to 29,202. The S&P 500 lost 0.75% to 3,612. And the Nasdaq Composite dropped 1.04% to 10,542. Microsoft stock was down 2.1% and was among the biggest drags on the three major indices. The S&P 500 technology led sector declines along with energy. And investors were also awaiting US inflation, of course, which will come out later this week. Consumer stocks were also in the red, pressurized by a slump in autos after UBS downgraded Ford Motors and General Motors on worries of demand destruction for automakers next year, as supply will likely exceed demand. UBS downgraded General Motors to neutral from buy and cut the price target to $38 from $56, and Ford to sell from neutral with a price target of $10 down from $13. And meanwhile, Rivian Automotive fell 7% after the electric vehicle pickup maker said it will recall nearly all of its EVs due to a possible loose fastener in the vehicle's front suspension. Defensive corners of the market, including utilities and consumer staples, did buck the trend lower to trade in the green, though. But oil prices sank by nearly 2% on Monday after 5 straight sessions of gains, as investors worried that economic storm clouds could foreshadow a global recession and erode fuel demand. Brent crude futures settled at $96.19 a barrel, down 1.8%, and West Texas Intermediate crude settled at $91.13, losing 1.6%. Both benchmarks had risen over the previous week, largely on expectations of tighter global supply. And oil prices also struggled under a strengthening US dollar, which rose for a 4th straight session. A stronger dollar, of course, makes crude more expensive for non-American buyers. The prospect of tightening OPEC Plus's oil supplies limited declines in prices, though. The Organization of the Petroleum Exporting Countries and allies, including Russia, known together as OPEC Plus, decided, of course, last week to lower their output target by 2 million barrels a day, although actually that decision will have only a muted impact on the oil supply markets, as actual output cuts will be smaller, Fitch Ratings said, noting that collectively the group was already producing less than its previous quotas. But the cut spurred a flurry of activity in the options market, but with more US bettors opting for a bearish stance, according to data from CME Group. Concerns over still relatively robust demand as the pandemic has eased, meeting potentially scarce supply, have been deepened as the European Union late last week endorsed a G7 plan to impose a price cap on Russian oil exports. The complicated new sanctions package could end up shutting in considerable supplies of Russia crude, analysts have warned. And meanwhile, services activity in China during September contracted for the first time in 4 months as COVID-19 restrictions hit demand and business confidence, according to more recent data. And gold futures were down again to 1,675. Silver was down at 1961, and Bitcoin was at 19,161. So the bumpy ride south through October is set to continue, though the volatility will remain high as the VIX was once more again above 32 in the US. So there's a lot more travel yet, but Dimon's warning of a 20% fall on the S&P 500 should be taken seriously. As I said earlier, brace for impact. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.